What's up, everybody? We back again. Hope y'all like my backdrop in this Airbnb. Getting to it. So that's why we doing a little bit earlier than usual. I'm over here on European time zone. So I'm a little ahead of most of you guys. I know for most of you guys it's either 1, 2, 3, or 4. So it's getting late where I'm at. So I wanted to make sure we've got on here, dove into this info. And then let's take a look at everything. Let me get my screen up. Hope everybody's been doing good. We've been flying through the year. We already in September. It's crazy. I feel like every time I do these, we already about to hit the next year. It's crazy. Time just is floating. But I hope you guys have been planting those seeds, getting after everything you guys want to get after and making things happen. Because like I always say, time waits for no one and ain't nothing about to just come get dropped at your front door. All right, let's take a look at these markets real quick. And I'm gonna take advantage. I'll get into that here at the end. Hold on, let me share my screen with you guys. Yeah. um, Crawl. Mm. Know what this is. All right. All right, boom. So let's take a look and see what's going on with this housing market. So we're going to cover three markets that are very good based off of metrics. Like I said, everything is really kind of a rule of thumb until it's not. You have these metrics that you can look at to kind of gauge and kind of give yourself the upper hand, and things work until they don't. So we're going to keep riding the waves and keep getting the knowledge and going off of what the information is telling us. So these numbers are from August. The median price was 439,000. It's actually a little bit lower than that right now. And then as we can see the screen, here we go. The mortgage 30-year fixed rate has been hovering at 6. So we've been pretty much between 6 and 7% since about September of 22. So for about the last 3 years, mortgage rates have been pretty much trending sideways. Anyone who caught these dips, if you want to call them that, in you know the COVID era, the prime time, the prime time to buy, everyone was getting in at high 1.75, 2% interest rates. Everyone they still sitting back, and I'm sure people that got in at this time probably won't sell for who knows, probably forever. But anyway, so this is how the market has been looking for those looking to get a mortgage. That's where we're at. And some of the metros with the fastest growing price down south, Buffalo, in the New York area, Michigan, North Carolina, and for the top five, homes for sale, a little over 2 million. Newly listed homes is down a little bit, about a month and a half for days on market for people selling. And as you can see, we're up. So there's a big supply out there with not so much demand right now. So high supply, low demand to job market numbers and stuff were recent release. A lot of unemployment. Unemployment is going up. The amount of time that people have been unemployed, that are unemployment, is up. It's like the average now is over 6 months. And then younger people just aren't able to get jobs. And those are typically a lot of the people that are looking to get into those homes. People that are in that 35 to 40 plus age range already are situated with their career. They got their families already going and started. They already got their home and things like that. So that 25 to 35 group, depending on what they got their degree on, how long they were in school for, and things like that. That's kind of the next group of people, and those people are getting hit the hardest with unemployment not able to find jobs because jobs want people with experience, but how are you going to have experience when you spent all this time in school and people are going to have to um, get creative and all that stuff. So we see uh, there's a big correlation in all that, so it's like these numbers only tell a small picture and we got to kind of look at everything as a whole. Homes sold above list price. 26% of homes have been sold above list price. 21% of homes have dropped. And then 98% of homes are selling for the list price that they want. And then these are the top 5 competitive cities in the US. It's crazy to see Tacoma on here and Richmond. Omaha, I can kind of see is starting to grow a lot more. People are starting to find out about Nebraska. Anchorage is another interesting one on the list. And then Indiana doesn't surprise either. And then as far as migration, the typicals, we already know people leaving LA, New York, those high expensive areas. So I would guess that a lot of people that are in Washington and that live there, they love it and are there because if you got to be up in Washington, you got to really love it. So that's more than likely why Tacoma is on here because a lot of people are leaving from the Seattle area and just going about 30 to 45 minutes away to that area. But as far as where people are moving to, Sacktown out there in Cali, that's been up there for a minute. Phoenix, so Sacramento and Phoenix have been on the list for a while. Florida's are still on there. South Carolina's still on there. Tennessee, Portland, Maine, and we see Jacksonville on there. No surprises with those. And something that I was looking at, so if you look at SPY, that's for those of you that aren't too familiar with stocks, SPI it's an ETF, so it's a basket of the top 500 companies that we have in America. So if you take a look at this SPY ETF, and if you kind of zoom out onto a monthly chart, and I went out about 5 years because that's about as far out as we can go here. So if you kind of look at mortgages around that time frame, when we were, if this could go back a little bit further, I don't know if this will let me go back just a little bit. If I could just go back one more year, let me see if it'll let me go back 6. All right, cool. So we see this dip right here. This was like peak COVID time when everyone thought the world was crashing and the world was ending. And this is that time frame when people were getting those crazy rates. There's a pretty big correlation between looking at SPY and then taking a look at mortgages and also a little bit sell price as well. So if you want to look and, a lot of people like to wait or, try to time the market. I'm not one to promote that or wait for that. I say if you can get your numbers in order and everything makes sense, pull the trigger. Don't try to wait and don't try to time the market because we know the people that are in charge and that are able to control this are crazy. And, trying to wait, you might be trying to wait forever. So it's like I remember back in 2019, 2020, 2021, 2022, telling everyone, get that property, plant that seed, get things in motion. And then we started to take off. And then when 2022 happened, everyone kept talking about, do you think there's going to be a crash? When are mortgage rates going to drop back down? And I was saying, I personally don't think that they were going to drop back down just for the simple fact that if we could look at a bigger time frame, the average for like the last 50 plus years for mortgages is about 7 to 8%. So we're back at about that average range we were. We just kind of got spoiled at that time. So I think a lot of people are thinking we might hit back in those areas. Um, like I said before, I don't think we're going to see those ones and twos again for a very long time. But anyways, back to my point, there is a little correlation between, SPY and the real estate market. So take a look at that. If any of you guys are familiar with, SPY, take a look, go back and look, go back a little bit further and just kind of take a look at some of that data. Look at the times that we were considered oversold. So up top here is the RSI, this block up here. Anything below 30 would be considered oversold, and anything above 70 is considered overbought. So technically right now we're at overbought, so the market is pretty hot. So in theory, if we have a slight pullback, then we should see a slight pullback in rates. So we'll see if the two match up in due time, right? Time will tell us. But anyways, yeah. So let's go on to these. Does anyone have any questions on anything before we move on to these markets? Let's see. I can't even see nothing. There we go. All right, cool. Let me bring up these slides real quick. All right. So we're going to take a look at a few metrics. So there's quite a bit that you can look at when it comes to real estate rules of thumbs. I've covered so many of them, the 1% rules, the 3% rules, the 5% rules, the 50% rules of thumb. And like I said, a lot of these metrics are rules of thumbs. You can find something that matches up everything that's on your list that falls under your criteria, and it may seem like a good buy, and then you can get into the property and it doesn't work out. Sometimes the metrics can be completely against, or majority of them are against, saying that it's a bad property to stay away from it, and that doesn't necessarily make it a bad property. So a lot of these are just rule of thumbs. You would like to get your numbers as close as you possibly can to just kind of give you, I guess, a upper hand. But like I said, at the end of the day, these numbers and these metrics doesn't, put that stamp that it's for sure going to be a great property. If any of you guys have ever owned any property, or have your own property, we know things go south very quickly. Things can happen out the blue. You can get, I'm trying to think, there was someone famous. I think I can't remember his name. The guy who does the food reviews. I don't know his name, but he got really popular on social media from doing food reviews, sitting in his car and stuff. He used to do like MMA, and then he finally got his first house. And if you guys go on his social media, he did a complete walkthrough. And this is also something crazy that I want to talk on, because this is happening to a lot of people that I know. So he had, I want to say, he said he had 2 or 3 different home inspections on the home that him and his family just bought. And he paid good money for it. It was a nice house, a newer house. He has the money to pay for, good home inspectors and get multiple home inspections and all that stuff. And what happened was his family kept getting sick. I'm not sure how many kids he has, but he has some kids, and he kept getting sick. His wife kept getting sick. His kids kept getting sick. Everyone kept getting sick. And what happened was he realized somehow that there was mold in the bathroom area, like under, they have like one of them jacuzzi baths, and he did a whole walkthrough, and everything was tore up from the bath, and there was mold inside the underneath that wasn't done. And when they ripped everything up, the contractors were whoever built the house prior to him buying it. I'm not sure if he bought it as a new build or if it was already built. I didn't get that too into detail of it. I just literally seen a quick blurb of it. But there was mold everywhere. There was mold all around, and they didn't know how far it ran into the house. So you can do everything right, and you can still have something pop up that's going to be detrimental to your health. And then also it's going to cost a lot of money to get fixed, because it was a big bathroom. It was one of them custom jacuzzi type of baths. And not only that, they didn't know how far out the mold ran throughout the house. So Um, Back to what I said, a lot of my friends, and for those of you out there, if you ever are getting sick, if your family or if you got kids and you guys are constantly getting sick, I would highly recommend getting some type of mold check. You know, mold is like that silent killer that you don't necessarily smell it, you won't necessarily see it. And, it was something that I never really thought too much about, prior getting into real estate, but I'm seeing it constantly happening more and more. There was actually a family that there was like a whole short, some news did like a story on this family. I think they were maybe in the Midwest or something like that. They kind of were having the same thing, and the whole house, come to find out, the whole house was covered in mold. They had poured everything into that home. They didn't have any money to really do anything about it. And then it's like once you find that kind of stuff out, if you go to try to sell, you got to disclose it. And what they would get for what they paid, it just didn't make sense. So I don't know what that family ended up doing. But I'm hearing more and more stories about this mold stuff starting to happen. So be on the lookout for that, for yourself personally, just for your health. If you notice that you might get sick more than usual, or maybe if you have family that gets sick more than usual. I have some friends that got taken out pretty bad, like it was in their behind in their shower. And then it's like when you're running that hot water, that steam going into your systems. A lot of times mold can build up in those areas where you have faucets. So sinks in the kitchen, sinks in the bathroom, bathtubs, things like that. That's where those are the key places to kind of start. So sometimes you might be able to see it from the discoloration, like on your boards and things like that. Sometimes it might be hidden behind it. So it definitely would be worth, if you feel like, you get sick quite frequently, or, something's just not right. It definitely might be worth spending the money to get that checked out. And the price will vary depending on where you're at, but I'm noticing that it's becoming more and more of a thing. All right, let's get back on topic. So real estate investing metrics are crucial for identifying strong investment opportunities. Understanding these metrics will help investors make informed decisions and maximize returns. So key metrics include affordability, cash flow potential, growth trends, demand indicators, and different cost factors. So right now, the top three areas that hit this list pretty good are Dallas, Indianapolis, and Tampa. And then Columbus, South Carolina is a heavy hitter as well. That's up and coming, that meets a lot of these metrics that investors look for. So in Dallas, I have it on another, so I'll have to go back and forth. I'll have to share the screen with the other one. I'll show you guys all the numbers as well, that I'm not just putting the numbers on here. We'll actually take a look. I got some other screens for you guys. Let me see if I could pull it up on there. Actually, hold on. Let me see something really quick. Let me make sure it's on the right one. Okay. Yeah, Keith Lee. Yeah, it was Keith Lee. Columbus, Ohio. Yeah, Ohio has always been a pretty good area. They just don't have um a lot of growth in home value. They're very slow with the Midwest is really slow with home value increasing. But anyways, so Dallas, Texas, the median home and the national average is about 420,000. That's why I said it's down a little bit from the metric that we were looking at earlier. Um, but let's see. Can you guys, for some reason, let me make sure. Okay, good. All right, go up. Slides are tripping. Boom, boom, boom. All right, Dallas, Texas. The median home price is about 400,000. Indianapolis, the median home price is about 265,000, and then in Tampa, the median home price is about 373,000. So all three of these areas already meet the first metric as far as affordability. So affordability is gonna, vary on each individual on, what you would consider affordable, but we're just basing these numbers off of the national averages. So when I'm comparing these, I'm taking what the national average is and I'm looking for those areas that either are right at it or below it as best as we can. So the cash flow potential in these areas is very high. Dallas, Texas, the rent to price ratio is about a little over 1% monthly. Indianapolis is about the same. And then Tampa is about the same. The national average is about right under 1%. And that's why I say those rule of thumbs. One of my favorite things to look at when I was looking at properties is the 1% rule. So the 1% rule, when it comes to buying a property, you want your rents to be about 1% of whatever you're buying that property for. So, excuse me. So let's say you're buying a house for 100,000, and if you were going to turn around and rent it out, you want to at least be able to make 1,000 or more in rent per month. That's the 1% rule of thumb. One of the rule of thumbs I was talking about. So that doesn't necessarily mean that you found a grand slam property just because it meets that. And it also doesn't mean that it's a bad property if it falls below that. The reason for that is because you have all these other rule of thumbs, right? You have to put money aside for maintenance. You have to put money aside for vacancies. You have to put money aside for insurance. You have to put money aside for, emergencies or things that come up. So a lot of things happen, not only when you have your own house as just your personal house, but on the investor side as well. Things come up all the time. You don't necessarily know how someone's taking care of your property. If you're in areas like Tampa, we know that you have high risk of water damage possibly happening, and then all other different types of things depending on where you're at in the United States. So, anyways, all three of these areas rent to price ratio is above the national average, so they check off the cash flow potential as well. For growth and appreciation, these trends are going to show the potential for increased property value and rental income. So as a landlord, this is something that's going to be important for you. If you were to get a mortgage and you get your mortgage locked in, let's say your mortgage, your principal, interest, your taxes and insurance and all that is at $1,000 a month, just hypothetically. And let's say the property that you get, you're able to rent out for 850. And let's say, you got to pay 1,000. So you got to cover that 150 on the back end. Over time, you want to be in an area that's growing, that you're going to be able to get appreciation with the property itself. And you also want to be able to grow your rents. So eventually your rents will surpass what your mortgage, your main P&I, taxes and insurance and everything is. Because your P&I, the only thing that will fluctuate is going to be your insurance, but everything else is going to be pretty much locked in. And so, by that, over time, in theory, you want your rents to get up to 1,100, 1,200, 1,300, and then that's what's going to be considered your cash flow. So whatever you make more than what you're paying for your P&I, your taxes and insurance and all that good stuff, what's left over, that spread is going to be your cash flow. And the name of the game is you want to keep increasing your cash flow. That's just going to be, money for you to save, invest, and then it's also going to help you, if you want to start, a real estate empire, if you want to keep getting more properties, that's also going to help when it comes to that. So over in Dallas, the annual home appreciation forecast is at about a little over 4%. And the average monthly rent growth is at 4%. And right now, the median rent I did 2 bedrooms, 1 bedrooms and studios are going to be less than these numbers. So just so you guys know, I pulled the data for 2 bedrooms, and the median rent in Dallas is a little over $1,500 a month for a 2 bedroom. Over in Indianapolis, the annual home appreciation forecast is almost at about 4%. And the average monthly rent growth is also at almost about 4%. And right now, the median rent for a 2 bedroom apartment is $1,117 a month. And down in Tampa, The annual home appreciation forecast is at 4.5%, about 5%, and your average monthly rent growth is about the same. And a two bedroom, but the median rent for a two bedroom in Tampa is $1,990. And let me move this out the way. Let me see. I live an hour from Indy, and that's correct. Yeah, I pulled. I'm not just making these numbers up. I'll show you guys all the numbers in the data, so you guys know me. I'm not just making this stuff up. But let me move this over. All right. So demand indicators such as vacancy rates, unemployment rates, population, job growth, these things are essential as well when it comes to assessing investment potential. And all these things, all these indicators and these rule of thumbs, there's literally, I've done so many classes breaking down all of these to help you guys out to be able to understand what these different rule of thumbs are. Like, for instance, the rule of thumb for vacancy is to put aside about 3 to 5% of your monthly rent. Put that aside to help in case you do have vacancies, at any point in time. So, like I said, there's so many different rule of thumbs for, maintenance, maintenance, vacancies, uh, you got a few of them out there. So, anyway, so for over in Dallas, the vacancy rate is at about 5%. It's very low compared to the national average. The national average is about 7%, 6.5. So Dallas vacancy rates are very low. Unemployment rate is at 3.5%. There's very high employment in Dallas right now. It's having a pretty steady population growth of about 2% annually and job growth at about 3%. Still very tech heavy out there. In Indianapolis, the vacancy rate is at about 5%. It's also really low compared to the national average. Unemployment rate is lower than Dallas, it's 3.2%. So there's a strong employment rate out there. Population growth has also been pretty steady, 1.2%, and annual job growth is slow and steady at 2%. Down in Florida, the vacancy rate is a little bit higher than the other three. It's about 6%, 5.5. Unemployment rate is at 3.4%. Population growth is steadily growing 2.1% annually, and job growth is doing the same. So just looking off of, those three indicators, these three areas also meet these pretty well. So I would recommend you guys look at Columbus, South Carolina too. They're doing really good as well out there as well, and they're steadily growing. Um, Another good factor is you also want to invest in places that people know about and will go to and travel to. That's also another good thing. It doesn't necessarily mean that it's gonna work out. I've had properties kind of out in the middle of nowhere in some states, and they did very well. And then especially I know a lot of people that are just kind of in those rural areas. And, when you have those rural areas, you have those long-term renters and things like that. So there's a lot of different approaches that you can take when it comes to real estate. And that's really the cool thing about it. You just really have to sit down and kind of figure out what niche, what route you're really trying to go, and kind of have like your 5 to 10 year game plan on exactly what you're trying to do. And then that will really kind of help you get started and have a better understanding of what market you want to hit. Because you got to think we have 50 states that you have the opportunity to invest in. Every state has some type of real estate program, whether it be down payment assistance, first time homebuyer programs, different rural real estate investing, different property taxes. If you're a veteran, there's a lot of states where you don't have to worry about property tax. A lot of states where insurance is very low and property tax are very low. Um, there's so many angles, a lot of states that have, they're very nurse heavy, or places that are near big universities that have kids constantly coming and going. And there's a lot of universities that have rules that after a certain period you can't stay in the dorm, so you have to be able to live somewhere. So there's a lot of places that people like to travel to that are considered vacation spots. Tampa is one of those. Dallas is one of those. Indianapolis can be at times. So it's like these are places that people are going to. These are places that people know of. They have, you want to be in places that have popular sports teams or big sports teams. It's like at least if you can get two out of the three major ones, NFL, NBA, MLB, NHL. So it's like if you can be in somewhere that has all four, great. If you can be in somewhere that has at least two out of the four, great. Um, those are all things that you want to look at. So, cost factors and landlord friendly laws significantly impact real estate investments. We've seen this crazy when it came to landlord friendly places. I mean, we've seen people, I think there's even some places where people are still squatting in places like up in Washington State and a few other places where people have squatted since COVID timeframe. Some places it's really got out of control. Things got so backed up that people were really able to take advantage of this for a really long time. For a couple years, people have lost their properties because they weren't able to afford because they needed that. A lot of people think that if somebody's a landlord and they have properties that they got their shit together all of a sudden, just like any just like any type of profession, there's people that are in this that don't handle their finances well. They might have two, three, four, 5 to 10 properties, but they're still living check to check and relying on that money to come in from their renters. And that's why we have tax liens. That's why we have tax deeds. That's why we have all these other forms of investing, because people weren't handling their business and taking care of what they need to take care of. So it's kind of really unfortunate, but that's just really the name of the game. We don't make the rules. We just have to follow them and use them as best as we can to our advantage. But anyways, over in Dallas, property taxes are about 1%. So the national average for property taxes are 1.1%. So property taxes in Dallas are a little bit higher than the national average, but that's offset by no income tax. The average home insurance is about 1,600 a year. That's below the national average. It's also landlord friendly, quick evictions, no rent control out there in Dallas. Over in Indianapolis, property taxes are low, 0.8%. And the average home insurance is 1,200 a year. That's pretty low as well. And they also have landlord friendly laws. Over in Tampa, we already know the insurance is going to be crazy. Property taxes are low. The average home insurance is higher than both, 2,200 a year, and that's high due to hurricanes, but it's below the Florida average. So over on the east coast of Florida, it's a lot higher and it's getting a lot crazier. And there's a whole set of different issues going on when it comes to real estate over on that side of Florida. It's landlord friendly, no rent caps, and it's pro landlord. And let me see. So some spotlights for these areas. So Dallas excels in job and population growth. It's driven by business relocations. A lot of people are relocating, especially in the tech industry. It's been, the high tech industry for a while. It's crazy. Back in 2015, 2016-ish, I had some opportunities to invest in some commercial property out there. I wish I would take advantage. Like I said, I just wasn't ready for that yet. But I remember then people saying, because, back then, Dallas was still kind of slowly growing, but it's not what it is today. And I just remember seeing some of the crazy deals that Dallas had to offer. So it's crazy how you'll hear things about an area, how it's about to grow. And then before you know it, 2, 3, 5 years, a decade goes by, and it's like, damn, you'd be like, I remember hearing about, Dallas back then. I knew it was going to grow because everyone kept talking about it. People kept moving over there. And then it's like now with the power of social media, you could really use it to your advantage. It's like if you're looking for the right things on social media, you can kind of see, people like to talk about when they move to a new city or, jobs opening, jobs closing, people, it's like on both sides of the stick. It's like you can hear the bad about, people losing their jobs and certain industries closing jobs down in certain locations. And then you also see the other side where people are moving to, getting more places. You see, Tesla is building a plant here, Amazon is building a plant here, Boeing is building a plant here. So it's like there's a lot of signs that you'll see on social media if you train your mind and know kind of how to block out the noise and look for the things that you're looking for. Social media will actually tell you a lot. Um, but yeah, strong rents out there are supported by high rent to price ratios and appreciation from the economic diversity that they have out there, especially with being landlord friendly. Texas don't play with a lot of stuff, and the no state income tax also will help boost your net returns when it comes to taxes and stuff like that. Over in Indianapolis, it stands out for affordability and the cap rates. We didn't really get too much into that. That's a lot more so on the commercial side, but cap rates can help a little bit if you're looking at, like fourplexes and things like that. Single families don't have to really worry about that too much. But anyways, low vacancies and low taxes over in Indianapolis, steady job growth in diverse sectors, which helps ensure you having demand out there. People are going to need somewhere to live. Low insurance and low crime rates as safety. That's another big one that I talk about a lot is, crime, school, uh, public transportation, cleanliness of the city, things like that. Those are also things you want to look at and take into consideration as well. Some spotlight on Tampa. Tampa balances growth with solid yields. You have the population influx from migration, especially, people migrating from all over Florida, and then people that are migrating in just those areas that are around that area. You got Louisiana, you got Mississippi, Alabama, you got Georgia, you got Tennessee up a little bit higher, you got some of the Carolinas right there. So a lot of people migrate to that area from those areas. They don't want to be deep down in Florida. And Tampa is a little bit different. If you guys have ever visited multiple cities in Florida, Tampa is a little bit different than the rest of Florida. Not necessarily saying it's better or anything like that, but it's just a little bit different. So that's why you definitely have that growth, and you have those few perks that you have. And then great appreciation out there and low vacancies. Two great things that you want to have. You want your property to appreciate. You want your rents to be able to increase, and you want to have low vacancies. Florida has great tax perks and landlord laws to make investing ideal for out there. The one downside to out there is the insurance cost that you have, and that's based off of what we discussed in the slide prior. So, like I said, these three markets and Columbus, South Carolina as well, these markets are projected to outperform nationally in 2025 due to the Sun Belt Midwest trends. And, for deeper analysis, you can check tools like MashVisor or local MLS data, get with the realtor, get the information. It won't cost you anything. And always run property specific numbers, right? Your NOI is going to be very important. There's a lot of calculators out there, bigger pockets. They have a lot of great calculators. And depending on what type of real estate investing you're trying to do, there's a lot of AI tools out there that all you got to literally do is plug the numbers in, and it will run all this for you. It will point out these different rule of thumbs. I mean, we're really in a time now where tech is just so crazy between the data that's out there, the information that's out there, the tools that are out there, AI. You really not necessarily have a fail-proof system that you can build for free, but it would be really hard to set yourself up for failure. You can really get yourself into some great deals just doing a little bit of legwork. So yeah, that's that. Before I go over, do you guys have any questions on anything Oh, I'm still on here. Do you guys have any questions on any of that stuff that I just covered before? The next thing I'm just going to show is the averages that I was already showing you guys in the slides. Um, Here's the 428,000 for the median price. Here's Dallas, some numbers for Dallas. It's been fluctuating. It's crazy in late 2024, half a M, 500,000. It's going down. It's going down a lot in Dallas. Indianapolis, you can see their numbers 26, 262,000 to 264,000. Tampa, 372 to 375. I got a few friends that live in Tampa. They really enjoyed out there. Tampa is cool. The average monthly rents in Dallas, 1,400. Said two bedroom is about 1,563. A one bedroom, 1,258. A studio, 1,100. Can definitely make something shake out in Dallas. Like I said, if you really just out there on your grind, get you a nice job out there, climb your way up, thug it out in the studio for a little bit. Let's see, Indianapolis, 1,100. Do any of you guys live in Indianapolis or ever invested out there? How you guys like it out there? I was an army recruiter in Tampa. I loved it. Yeah, everyone, I've never heard anybody say anything bad about Tampa as far as living. I have heard people complain about, the cost of living going up out there, but other than that, besides the cost of living, everyone I know that's lived out there, they love it. Um, Miss D Moore Max, you said you live an hour from Indy. If you're still on here, you ever go out there and spend some time out there? How is it? I live in Cincinnati, which is close. I like Indianapolis because it's a sports town and family friendly. My sister lives there. And see, that's what people look for that live there. If you like Cincinnati, I would recommend investing out there in Indy. That's why I tell people, um, you don't have to invest where you live at. I was invested in about 5 different states. Um, at first, it seems like it'd be a little tricky or a little difficult to manage properties in an area that you don't live in, but that's what property managers are for. And I have a whole class, multiple classes. I think even a couple of them, I even called a property manager live just to let you guys hear how to talk to them, how to ask, a few questions and what questions to ask and things like that. I live pretty close, and my sister lives in Ann Arbor. She loves it. Yeah, I've heard good things about Indianapolis too. Um, I need to get out there one of these days. Average rent in Tampa, it's crazy. A studio is 1,500, but it costs to be in those nice places, and you're kind of right by the water. Two bedroom, about 2,000. Still not too bad. Like I said, if you got two incomes coming in one household, that wouldn't be too bad. All right. Do you guys have any other questions for me? Or is there something you guys want me to show you, or do you have any questions? Have you done any rehabs on out-of-state property? Yes, I have. I bought properties on auction. I did a class. Um, I use this website called Bid for Assets. Let me go to it. So getting rehabs done is a little bit trickier Because I've done where I've bought properties in states that I didn't live in, that I never even visited. I just reached out to property managers. I've dealt with realtors. So the thing about the realtor industry, if you have a realtor that you've dealt with or you've closed a property with, and you tell them, hey, I'm thinking about getting a property, let's say you live in Oregon and you bought a house in Oregon, or you bought a property in Oregon, whatever the case may be, a realtor that lives in Oregon, and let's say you want to buy a property in Texas. So you tell your realtor that you've dealt with or know, like, hey, I'm thinking about buying a property in Texas. They'll say, oh, I know someone out there. A lot of times they may know someone, or a lot of times they might not. But in the realtor world, they get a referral fee. So they'll do the work and find someone for you. And the cool thing about the realtor game is, you just have word of mouth. So you want to do right by the people that you're working with, because they'll refer people to them, and their name is kind of on the line. In that world, your name means everything. And so they'll find someone for you. So what I would do was, realtors that I've dealt with, and I try to spread out the wealth as best as I can, because I've really been blessed with all the realtors that I end up working with, and all the property managers and the home inspectors. I don't know if, I'm pretty proactive, and I like to be involved as much as I can. And just, I don't know, maybe it's just, I think I truly believe you get what you put out, and I try to put out like a lot of positive energy, and be straight up with people. So I've been blessed my whole real estate career with being surrounded by good people. But anyways, back to the point, they'll refer you to someone, they'll find someone for you. And so that's what I did. So when I would get properties out of the state that I was living in, I would let a realtor help me find someone. They would find me someone, I would connect with them on the phone, and then they would put me on to their team. So I'd be like, hey, do you have any property managers? And then they'd be like, yep. And then I'd say, hey, well, do you have any project managers? I might need some rehab on this property. And they'd be like, oh, yep, I got someone. A lot of times, even if they don't, they'll find someone for you, or they know someone that knows someone that might know someone. So it's a little bit trickier. You need a team that you trust, because you're going to need someone to have boots on the ground. So you could either take the time and go fly out, which you may have to at times, just depending on, the size of the property, the size of the job, how much money you're actually investing, and how much money is needed in the property. So for bigger deals, I've went, and then for deals that I didn't really consider too big, and that's going to be individual based, I didn't really worry about it too much, because if it went completely south, it wasn't something that was going to take away from what I was doing. Um, so yeah, so if you do rehabs on properties that are out of state, you definitely need a good team, people that you can trust. And like I said, depending on what type of money is involved, will that's going to be on you to decide on, hey, okay, I'm having to put this much money into it. I definitely need to, go out there, spend a little bit of money on a flight, get a hotel, or if it's a property, I know someone who would buy auction properties, and they would live in them while they rehab them. So they had a team, but they were on site. They didn't necessarily, that wasn't their main state that they lived in, but when they would find good deals, they would go live in the property, and they had about a month. Once you get good, you'll know how long it should take to rehab a property. Starting out, it might take a little bit longer, but as you continually do it, you'll start to know how to reach out to the right people. You'll start to be able to run numbers very quickly, and then you'll start to know how long certain jobs should take, and then you know when to let people go, and when to keep people on and keep them around for multiple deals. But I did a class on this. I will buy beat up properties on here, and I would either fix them up, get them rented out, or I would buy them and list them right away, and see if I got any bait. So the very first one I did, I was all in for about 19,000, and I was able to turn around and sell it for about 30,000. After fees and everything, I made about 6,500, and the whole thing took about 2 months. There's also been deals that I got on here that went completely south. I end up being all in on a property for like 22,000, end up selling it for about 20,000, and then with fees and stuff, I end up losing about like 5,000. So there's, like I said, it's ups and downs. There's gonna be You'll have, depending on how many properties you're looking to get and the type of properties that you get, you'll have the good side, and you'll also there are, bad sides to real estate as well. So even if you have all your numbers lined up, even if everything looks great, but for the most part, if you have your numbers looking right and everything looking great, at least you're off to a better start than the other. So, but yeah. All right. Do you guys have any other questions for me before we wrap this up? No problem. All right, cool, cool. So I appreciate everyone tapping in, taking the time out of your day. Hopefully, you guys were able to take away a little something from today's class. This is going to be recorded. If anyone wasn't able to watch the whole thing, or if you came in midway through, it's going to be recorded and uploaded. And then you can also find all the other classes that I've done in the university. On the new website, you can click the provider that you want, and then you'll be able to see all the classes that they've done. Easy stuff. So, like I said, if this is something that you're trying to get into, go back, check those classes, learn how to run your numbers, learn how to deal with property managers, learn how to deal with realtors, learn how to deal with lenders, learn how to deal with home inspectors, all that good stuff. We have lenders within the Well Squad that are constantly open to helping members. We have realtors in the Well Squad that are constantly open to helping members. Go to the real estate chat, put in what it is that you need, what you're looking for, what you're trying to do. You guys can also message me in the Discord. So all the old videos it's in the university. So if you go to Well Squad University, if you go to the main Well Squad, there's a link. Um, Let me see what it says in the Discord, what the exact one. So if you go up to the top in the Discord under the information section, you'll see the Well Squad University. So there's a link that's in there. It's the Well Squad University link. It's going to take you to the main Well Squad like landing page. And then once you sign in from there, you can go in and then you can find the provider that you want, the topic that you want, because I have videos that are about travel, Bitcoin, and real estate. So you can filter it based on what you want. So they're all the videos that I've ever done, which is years and years worth of videos that are all in there and uploaded. So and all the videos are typically about an hour long. Sometimes you guys have me on here going, and sometimes they'd be 2.5 hours long, just depending on the topic and what we had going on. So. But anyways, I appreciate you guys, and like I always say, the best time to do anything was yesterday. The second best time is today. Don't wait. Don't keep putting stuff off. Whatever it is, whether if it's real estate, investing, starting a business, getting that fitness in check, getting that diet in check, getting your mental health in check. Um, Whatever the case may be, it's not going to change unless you change it. So. One day at a time, that's all we can do, right? We don't know if tomorrow's gonna come, so we just really gotta take advantage of today. Don't be I'm gonna do it Monday. Don't be I'm gonna do it this weekend. There's something that you can do right now. There's literally, I like to call it the 1 minute, the one lap, the one push up. There's something that you can do right now that you can just knock out, that you did it, spend 1 minute on it, whether it be 1 minute reading, 1 minute researching, 1 minute writing a game plan down, 1 minute writing some notes, whatever the case may be, just, get it out the way so that way you can get the motion going and then just keep building up from there. And then before you know it, you'll be closer to, this time next year, if you take action every single day, you'll be surprised at how far you can get from just a little bit every day. So, Hope you guys have a great rest of your week. And that's all I got. I'll catch you guys next time.